Hello, welcome to Business Incorporated. I'm Laddie Williams. Coming up on the show today, AFDB named the world's best multilateral financial institution for 2021. And Ghana eyes $5 billion with virtual bond roadshow next week. And Cameroon signs economic partnership agreement with the United Kingdom. But first, let's take a look at the markets. Nigeria's main index reversed the negative trend and advanced 0.67%. As industrial heavyweight Dangote Cement added 3.64%, which pushed the sector up by 1.74%. The NSE also received final approvals from the Securities and Exchange Commission and Corporate Affairs Commission for its demutualization plans. On the flip side, the GSE slipped 0.2%, while the EGX 30 in Egypt fell 0.79%. And investor sentiments in the Middle East were positive across major markets at intraday. The Qatari index posted the strongest gain of 1.52%, while Saudi Arabia's market advanced 1.10%. Elsewhere, Abu Dhabi's index rose 0.42%, while Dubai's main index advanced 0.34%. And European stocks were mixed this morning, struggling to build on the momentum seen earlier in the week following a rally on Wall Street. Let's cross over now to Chelsea for more from the European scene. Hello, Chelsea. Great to have you. And I see Germany's opposition lawmakers today gave an update on the investigation into the country's biggest accounting scandal in post-war history, the Wirecard saga. What did they say?
Well, just to start with a little bit of background, Wirecard was really the star of the German fintech scene here in Germany. It was involved in basically facilitating online payments for companies all over the world. But last year, the company really blew up in smoke, went bankrupt. Its CEO was arrested, remains in jail. Its CFO fled the country and is now a fugitive after it was revealed that there had been widespread accounting fraud at the company. What this parliamentary inquiry is looking into specifically is how regulators didn't really catch this. There had been warnings about fraud at this company for years, but really the financial regulator, BaFin, had turned a blind eye to this, and that's really where the political pressure now is focusing on. What the opposition lawmakers announced today, what they said today is that after 5 months of investigation, they can really see a lot of places within the German government where things went wrong. First off is that BaFin, the financial regulator, there had been a lot of people who worked at this regulator who were actually invested in the Wirecard stock. So they had a legitimate financial interest in this company staying afloat. As well, they've been looking into the role that Angela Merkel had played in this as well. Before the company's collapse, she had been lobbying for Wirecard in China, even after some of these concerns had been raised. So there is a lot of discussion today and over the past several months about how regulation can be improved. They're still working on this, but it is something that is a major focus for the government right now. But I'd say we're still awaiting one of the big moments of this investigation, which will be when Angela Merkel testifies to Parliament about this case next month.
All right, let's look at tech now. EU competition chief Margaret Vestager told a German newspaper that she wants to build a tech alliance with the U.S. to take on China. How would this alliance work?
Well, this is something that's being discussed a lot right now, especially after the inauguration of Joe Biden. We've heard both EU and U.S. officials discussing how they want to really band together to challenge China. And the EU and the U.S. really share a lot of the same concerns about China's trade practices, about its subsidization of state-run industries in China, as well as forced transfer of technology that a lot of companies in Europe and the U.S. complain about to get access to the Chinese market. But they also are growing increasingly concerned that China is going to dominate some of these next wave technologies. So things like semi-autonomous vehicles, self-driving vehicles, the cloud infrastructure, artificial intelligence. China has really been leading in the development of those technologies. The EU and the US don't want to get left behind. They don't want to be reliant on China for those technologies. So they want to potentially think of ways that they can work together on developing some of these these next wave technologies, as well as potentially standardizing some of the regulatory or intellectual property standards for these technologies as well. For Europe, it is a fine line for them to walk because they're so dependent on China for a lot of their businesses, but they have really started to move more and more towards the US as concerns over Chinese trade practices as well as human rights abuses grow.
And China really is a force to reckon with. But new European rules went into effect today requiring more transparency in the growing market for sustainable investment. What are the new requirements?
So the new requirements they basically are intended to make it very clear for investors in European assets what is sustainable and what isn't. Over the past several years, we've seen the market for green assets, for socially sustainable assets really explode. And as a result, we've seen a lot of assets being marketed as green that aren't really. If you look at one of the top exchange traded funds in Europe that's billed as an ESG and environmentally and socially responsible fund, it actually is invested in basically all the major oil companies in the world. So what these new rules will require is for companies, fund managers to disclose what social and environmental sustainability processes they have in place, and in result, there will be basically a label put on these assets. You can either be green if you're really sustainable, a lighter green if it's less sustainable, or not sustainable at all.
All right, Chelsea, thank you so much for the update. Do enjoy the rest of your day. And the UK stock market has opened lower with the blue chip FTSE 100 down. Let's talk to Juliana now for updates from London. Hello, Juliana. Great to have you. Lots of corporate news on the wire. London estate agent Foxtons has reported a strong start to the year. And I'm guessing it's due to the rental market recovery from the pandemic.
Well, there's certainly some recovery, but it's not necessarily the rental market, Laddie, because typically in London, especially for the short-term lets anyway, it's international students and visitors that take up that demand, and there just hasn't been any. So we're certainly in over supply at the moment. But if you want to buy a house, then now is the great time to do it. And this has been reflected in Foxtons' results. They say that they're having an amazing January and February, and this comes after they posted losses of 2020 at about £93.6 million. A little bit surprised that they have these losses because, of course, in the second half of last year, we did see a housing market boom. The housing market was the first sector to be given the green light in the summer to open by Prime Minister Boris Johnson. And then, of course, in July last year, Chancellor Rishi Sunak announced that stamp duty holiday of homes for up to £500,000. It was to end in March the 31st, but that's now been extended to the end of June. I think Foxtons, of course, are a little bit upbeat about this year because we now know that there is this extension of the stamp duty holiday, plus an extra added bonus was that last week during the Chancellor's budget, he announced that the government will be offering 95% government-backed mortgages from several high street lenders, meaning you'd only have to put down a 5% deposit. So that's certainly added a little bit of boom, and which is why we're seeing that they're a little bit more optimistic about the outlook for the rest of the year.
Yeah, interesting. And with so many restaurants closed, the takeaway service Just Eat is seeing strong demand this year. But even with the stronger growth, Just Eat made a loss last year. Could this be attributed to advisory and integration costs from the merger of Just Eat and Takeaway.com and the proposed takeover of Grubhub?
Yeah, absolutely. I've got to tell you, Just Eat, one of the major risers on the FTSE All-Share this morning. Their shares were up at one point of about 5%, and that's because even though they've got these overall underlying losses, revenue last year surged by more than 54% to £2 billion. I think Snoop Dogg helped with that. He's got a really funny advert with them at the moment. I'm not sure if you've seen that in Nigeria, but we have here. Pretty funny. Of course, this is down to the lockdown. People at home are buying more takeaway. I know I certainly am. And, this doubles down on the results we had earlier this week from one of their competitors, Deliveroo. Yes, there are underlying losses, and that's because they are, massively growing and expanding. There was the merger with takeaway.com. Now they are going to be buying Grubhub, so that should be happening in the next couple of months. And they did say to investors that their strategy is going to be more investment, so expect more of that. But like I said, their shares are one of the biggest fallers, biggest risers this morning.
I can imagine. I like takeouts too myself. Wagamama chain is looking to raise £175 million from shareholders as it continues to struggle with the impact of COVID-19 and also prepares for life after the pandemic. Tell us more about this and how the markets are reacting to this flurry of corporate news.
Yeah, all this talk about food is making me stutter, getting me really hungry. But yeah, the restaurant group, which is the owner of Wagamama and Frankie and Benny's and other really popular restaurants and pubs here in the UK, are struggling. They were struggling before the pandemic, as were lots of restaurants. It became a very oversaturated market. And, they've been opening, closed many times over the past 12 months. They've been closed for weeks on end, and they're asking for this money. This comes as they've already cut 3,000 jobs. They've already closed about 250 of its restaurants. They haven't yet touched the Wagamama brand, but they are going through £5.5 million every single month. We're not expecting restaurants to open fully until the 17th of May. There will be casual eating outside of restaurants from the 17th of April, which is about 5 weeks' time. So yes, they're hoping that they can get through this period, but it's not looking great for them or anyone else in the hospitality sector at the moment. But the FTSE opened in the red at early trading, and it's still there at intraday. The FTSE All-Share is down 0.02%. FTSE 100 is up slightly by 0.02%, and the FTSE 250 down by 0.29%. In the currencies market, the British pound is up against the US dollar by 0.4%, up against the euro by 0.04%, and up against the Japanese yen by 0.25%. Laddie, I made it.
All right, Juliana, thanks for the update. You can go order whatever you want right now. Thank you.
Thank you.
And Asia-Pacific markets traded mixed as stocks in Australia, Japan, and South Korea struggled to hold onto earlier gains. Investors overnight returned to risky assets, confident that a massive U.S. stimulus package will soon be approved. The Nikkei 225 gave up early gains to close near a flat at 29,036, and the Topix index rose 0.11% to end at 1,919. South Korea's Kospi pulled back gains of more than 1% after market open and finished lower by 0.6% at 2,958 index points. In Australia, the benchmark ASX 200 could not sustain early gains and finished down 0.84%, while the Hang Seng index in Hong Kong rose 0.35% in a late afternoon trade. Chinese mainland shares were mixed. The Shanghai Composite finished near flat at 3,357, while the Shenzhen component rose 0.65% to 13,563 index points. And stock futures rose in early trading following a sharp rebound in technology shares amid falling bond yields. Futures on the Dow Jones Industrial Average were up 0.37%. S&P 500 futures and NASDAQ 100 futures also were positive by 0.24% and 0.20%, respectively. On Tuesday, the NASDAQ Composite climbed 3.7% to post its best day since November as investors poured back into popular growth names after a recent pullback. Investors will monitor today's inflation data to gauge if price pressures are running hot. I will bring more stories from the African continent in a moment. Do stay with us. Welcome back. Yesterday, Statistics South Africa released the country's GDP report, showing strong improvement for the fourth quarter. South Africa's economy, which was in a recession before the COVID-19 pandemic, deteriorated sharply last year after the government imposed a strict lockdown to curb the spread of the coronavirus. Let's talk more about the numbers with Trinity Nkube, an economic analyst in South Africa. Hello, Trinity. Thank you for joining us.
How are you doing? Thanks for having me again.
Great to have you. So data released yesterday by Statistics South Africa shows that the economy grew 6.3% in the fourth quarter of 2020. Was this in line with your expectations?
At this point, yes. The economy is opening up and a lot of positive things are happening, although we're still in trouble still. This is a source for optimism and a platform to build onto. So yes, it is pretty much in line with what we're expecting. These are the short-term trends. However, I'm sure we'll talk about the long-term trends from there on, because if we compare with pre-COVID, it is really not a really rosy picture, but it's somewhere to start from.
So what sectors were the major drivers of the fourth quarter recovery?
I would say manufacturing, transport, trade, we're opening up, as well as tourism, although it's not widely recorded. However, as we have seen, the alcohol ban being overturned and being relaxed, we're starting to see tourism, the beaches being open. Things are starting to improve all around. But yes, those three major sectors, manufacturing, transport, and trade, we're starting to see a lot of activity in those areas.
Okay, although the GDP expanded in Q2, the country recorded a big annual contraction. What does this say about the economy, and what should the government be doing at this point?
That's an excellent question. This is something that I've always addressed in terms of when we look at the entire economy, it was always going to go through this trajectory. If you remember, before the COVID pandemic, we already had, the rating agencies putting us in junk status. So it's not like the COVID came in and did all of this damage. We already had a very negative outlook before then. So when you look at it at this point, obviously things got worse. And as expected, I think the IMF came in and we were looking at around 7 to 8% contraction. And as you said, we are around that figure anyway at this point. So in terms of government, I'm not the one to put all the responsibility on government. I think if anything, across the world, we have seen that governments are overwhelmed. There's so much that they can do. Yes, we have issues like corruption and all of this type of stuff. However, I would like to put responsibility to each and every individual to look within, to be able to move from where we are, everybody to play their part. I think we need to go away with the idea of entitlement, that the government is going to do everything. I think we're at a point where we can't just look for government to create jobs. We can't just look at government to create a momentum in the economy. However, we have to look at the micro units, the households, the individuals, to create jobs, to create momentum. So all in all, government is there to have a conducive space for us to do business. However, the responsibility stays with the individual. Each individual, if you look at the executives and the leaders and entrepreneurs that we coach within our system, we are always pushing the same message. We all need to go out there and create jobs, create businesses. We cannot expect foreign direct investment, government, and all the people from the outside to help us. Yes, let's do it from the inside out, and then we can attract the right partners.
Okay, what sectors would you like to see improve to actually help the economy at this point?
I would say let's have innovation across all our major sectors. If we look at agriculture, if we look at the manufacturing, what we are saying is let's have the majority of the people being involved in these areas, because what we have seen is that we can have growth, but that's jobless growth. That's not inclusive to the majority of the players. The moment we have all the internal players coming into those spaces, innovating, coming into agriculture, doing agro-processing, adding value. Now we have wealth creation that's involving all major players. Unfortunately, we have a paternalistic view in which all the other players are taking the back stand. So, oh no, government is going to come in and rescue us. So we are saying the African people, the South African people, need to step up their game, level up, get involved in all these areas. And then when you get moving, I can promise you, government likes to move in, jump on a moving train.
What's your outlook for first quarter 2021?
So we have some lagging figures in which things look a bit better than expected. So we are looking at least decreasing the contraction, perhaps by a percentage or percentage or two, points that can get us into a better platform to build from there. If you look at the global outlook, the economy at the end of this year is looking at the global economy is looking at about 5.6%. We're probably just behind that. However, I'm looking at things really improving from there on. And if everybody comes to the party, we are looking at a more positive outlook. Perhaps not pre-COVID, but yeah, I think things will look well once everybody gets involved.
I'll say that's a good start. Anyway, thank you so much for your time, Trinity Nkube. Thank you so much for joining us today.
Oh, thank you so much for having me again.
And Ghana will begin a roadshow next week to raise $5 billion from the international capital market as it seeks to close its 2021 budget financing gap. This will be the first time Ghana will hold the virtual meetings with investors prior to an international debt sale. The sale will help finance its budget gap, which is expected to narrow to 8.3% of gross domestic product this year, down from a projected 11.4% shortfall in 2020. Ghana's finance ministry says that part of the proceeds from the year's capital market program will be used for liability management of both Eurobonds and domestic bonds. Ghana intends to raise the target amount through Eurobonds, diaspora bonds, and sustainable bonds, as well as syndicated bridge loans. And Global Finance, a prestigious U.S. magazine specializing in financial markets and investment banking, has named the African Development Bank as the best multilateral financial institution in the world for 2021. The award is a global recognition for the path-breaking efforts of the AFDB as it transforms itself into a solutions bank for Africa through a combination of its operations, knowledge services, and investment positioning, which continue to help accelerate Africa's development. And this is an affirmation of the success of operational strategy being pursued by the AFDB under the leadership of Akinwumi Adesina, who was unanimously re-elected to a second consecutive 5-year term as president of the institution last year. This award comes after ratings agency S&P Global affirmed the AFDB's AAA and A1+ rating foreign currency issuer credit rating with a stable outlook in February 2021. And Cameroon and United Kingdom have signed an economic partnership agreement which provides certainty for British and Cameroonian businesses, ensuring they can continue to trade as freely as they do without any additional barriers or tariffs. The trade deal, which will support jobs and build future prosperity, will make sure around £200 million of trade between the UK and Cameroon can continue, supporting Cameroonian businesses to increase operations, enabling UK exporters to sell more goods, and boosting prosperity for both countries as together they recover from the COVID-19 pandemic. And this comes after the agreement to roll over current EU-Cameroon trading agreements concluded at the end of December. And that's it on Business Incorporated. Thank you for watching. I'm Ladi Williams. Bye for now.